Good financial habits versus bad financial habits. Identify habits that build wealth versus habits that destroy it. Money is one of the few things that affects almost every part of our lives. It influences where we live, how we travel, the opportunities we can access, our stress levels, and even our relationship. Yet financial success is rarely determined by how much money someone earns around the world. There are people with high salaries who constantly struggle with debt, and there are people with average incomes who quietly build significant wealth over time. The difference usually comes down to habits. Financial habits are the small decisions we make every day, whether we save before spending, whether we plan, purchase, or buy impulsively, whether we invest for the future or postpone it until later. These seem seemingly ordinary choices compound over years, just like interest. Good habits create financial freedom, bad habits create financial pressure. In this video, we will explore 10 powerful comparisons between good and bad financial habits, understand why they matter, and see practical examples that anyone from students to professionals to retirees can apply. Point number one: spending less than you earn versus spending everything you earn. The foundation of wealth is surprisingly simple. Spend less than you earn. It does not matter whether your monthly income is $500 or $50,000. If your expenses consistently exceed your income, financial stress becomes unavoidable. On the other hand, consistently living below your means creates a surplus that can be saved and invested. Many people assume wealth begins with a higher salary, but wealth actually begins with a positive cash flow. Good financial habits encourage thoughtful spending, prioritizing needs over wants, and avoiding lifestyle inflation every time income increases. Bad financial habits often involve upgrading cars, gadgets, clothes, clothes, and vacations immediately after receiving a raise. While these purchases may provide temporary satisfaction, they reduce long-term financial security. Financial discipline does not mean you are enjoying life. It means ensuring today's lifestyle does not steal tomorrow's opportunities. The gap between income and expenses becomes the seed from which future wealth grows. Every dollar that not spent today has the potential to earn additional income tomorrow through investing. Over decades, this habit creates remarkable results. Let's say example for this. Two friends each earn $4,000 monthly. Sarah spends $3,200 and saves $800 every month. James spends full $4,000 after 10 years. Sarah has built investments worth tens of thousands of dollars, while James still lives paycheck to paycheck despite earning the same salary. Next point number two: paying yourself first versus saving whatever is left. Many people believe saving happens after paying bills. Unfortunately, there's usually very little left at the end of the month. Wealth builders reverse this order. They automatically transfer money into savings or investments immediately after receiving income. This principle is known as paying yourself first. It treats saving as a mandatory expense instead of an optional one. Automation removes the temptation to spend the money elsewhere. Bad financial habits rely on willpower alone, which often fails because unexpected expenses and impulsive purchases consume available cash. Good habits create systems that make saving effortless and consistent. Over time, regular contribution, even small ones, benefit from compound growth, allowing wealth to accelerate. Financial success is often less about large deposits and more about consistency over many years. By prioritizing future goals before present consumption, individuals gradually build financial independence and reduce dependence on debt during emergencies. Let's say example: Emma automatically invests $200 every month as soon as her salary arrives. David promises himself he will save whatever remains. Most months, David saves nothing because unexpected spending consumes his income. Next point number three: investing early versus waiting for the perfect time. One of the biggest mistakes people make is believing they need more money or better market conditions before investing. The truth is that time is usually more valuable than timing. Starting early allows compound interest to work for decades, turning modest investments into substantial wealth. Good financial habits recognize that consistent investing through different market conditions often outperforms waiting for ideal opportunities. Bad habits involve endless postponement because markets seem uncertain or because people believe they need expert knowledge first. In reality, no one can consistently predict market highs and lows. Regular investing spreads risk across time and removes emotional decision making. The earlier someone begins, the more their money earns returns, and those returns generate additional returns. This compounding effort becomes increasingly powerful over long periods. Let's say example: Alex begins investing at the age of 22 with small monthly contributions. Ben waits until the age of 35 to start investing larger amounts. despite investing less overall. Alex accumulates significantly more wealth simply because his investments had more time to grow. Next point number four, creating a budget versus spending without a plan. A budget is often misunderstood as a restriction. In reality, it is a roadmap that gives money a purpose. Before it's spent, good financial habits involve tracking income, planning expenses, and reviewing spending regularly. Budgeting helps identify wasteful spending and ensures money supports personal goals rather than random impulses. Bad financial habits involve guessing expenses, relying on memory, or checking bank balances before making purchases. Without a budget, people often underestimate recurring cost and overestimate available money. Budgeting also reduces financial anxiety because individuals know exactly where their money is going. It provides flexibility while maintaining control. The purpose is not perfection but awareness. Even small adjustments made through budgeting can free hundreds or thousands of dollars annually for investing and or emergency savings. Next example, Maria tracks every monthly expenses and realizes is she spends over $250 on food delivery. After reducing that amount, she redirects the savings into investment without reducing her quality of life. Next point number five, building an emergency fund versus depending on credit cards. Unexpected expenses are inevitable. Medical bills, car repairs, job loss, or home maintenance can happen to anyone. Good financial habits prepare for uncertainty by maintaining an emergency fund covering several months of essential expenses. This financial caution prevents temporary setbacks from becoming long term financial distresses. Bad habits rely on credit cards or personal loans whenever emergencies occur, creating additional interest payments and debt. An emergency fund provides both financial protection and emotional peace of mind. Instead of worrying about unexpected bills, prepared individuals can focus on solving problems. Building this fund takes time, but every contribution increases financial resilience and reduces dependence on borrowing. Let's say example, when Liza's car suddenly needs expensive repairs, she pays using her emergency savings. Tom faces the same repair but uses a high interest credit card, increasing his debt for months afterward. Next point number six, using debt wisely versus living on borrowed money. Debt itself is neither good nor bad. How it's used makes the difference. Good financial habits involve using debt strategically for appreciating assets or education that increases earning potential. Bad habits involve borrowing for luxury items, vacations, or daily expenses that quickly lose value. High interest consumer debt quickly destroys wealth because interest payments consume future income. Responsible borrowing requires understanding repayment terms, avoiding unnecessary loans, and paying balances on time. Financial freedom becomes difficult when large portions of monthly income go toward servicing debt instead of building assets. Let's say example for this. Anna takes a loan to complete a professional certification that increases her salary. Brian finances expensive electronics and vacations on credit cards. Anna's debt increases her income. Brian's debt reduces his future financial flexibility. Next point number seven, continuously learning about money versus ignoring financial education. Financial education is one of the highest return investments anyone can make. Good financial habits include reading books, following trusted financial educators, understanding investing principles, taxation, inflation, and retirement planning. As financial literacy improves, decision making becomes more confident and effective. Bad financial habits involve avoiding financial topics because they seem complicated or assuming someone else will handle money decisions. Unfortunately, ignoring financial education often leads to expensive mistakes, scams, poor investments, or missed opportunities. Learning does not require becoming a financial expert overnight. Even small improvements in knowledge can produce lifelong financial benefits. Example for this point, Daniel spends 30 minutes every week learning about personal finance. Over several years, he becomes confident managing investments, taxes, and retirement planning, while many of his peers remain financially uncertain. Next point number eight, thinking long term versus chasing instant gratification. Modern society encourages immediate satisfaction through one click shopping, easy credit, and constant advertising. Good financial habits prioritize long term goals over temporary pleasures. Wealth builders ask whether today's purchase will still matter years from now. Bad financial habits prioritize immediate happiness regardless of future consequences. Delayed gratification does not eliminate enjoyment, it simply aligns spending with long term priorities. Every financial decision involves opportunity cost. Money spent today cannot simultaneously be invested for tomorrow. Understanding this trade off leads to wiser choices and greater financial freedom later in life. For example, instead of upgrading to the newest smartphones every year, Michael keeps his current phone for 4 years and invests the difference invested the difference, allowing his investment to grow significantly. Next, point number 9. Diversifying income versus depending on a single income source. Relying entirely on one paycheck creates financial vulnerability. Good financial habits encourage developing multiple income streams through investment, side businesses, freelance work, royalties, rental income, or dividends. Diversification increases financial stability because losing one source does not eliminate all income. Bad financial habits assume one employer will always provide long term security. Economic changes, automation, or unexpected layoffs can quickly challenge that assumption. Multiple income streams provide flexibility, accelerate wealth building, and create additional opportunities for financial independence. Example: Sophia has a full time job while earning additional income from freelance graphic design and dividend investments. When her company reduces working hours, her additional income helps maintain financial stability. Next, point number 10. Reviewing financial goals regularly versus living financial on autopilot. Financial success is not achieved through one good decision, but through continuous evaluation and improvement. Good financial habits include reviewing budgets, investment performance, saving goals, insurance coverage, and retirement plans regularly. Life changes, marriage, children, career growth, or retirement require updated financial strategies. Bad habits ignore finances until problems appear. Regular reviews help identify opportunities, correct mistakes early, and maintain progress toward long term goals. Small adjustments made consistently often have a much greater impact than dramatic changes made too late. Example: every 6 months, Olivia reviews her financial goals and adjusts her investment contributions after receiving salary increases. Over time, her wealth grows steadily because her financial plan evolves with her life. Finally, good financial habits rarely produce overnight success, but they create extraordinary results over time. Every dollar saved, every investment made, every unnecessary expenses avoided, and every financial lesson learned contributes to a stronger financial future. The good news is that anyone can begin today. You don't need a six-figure income or advanced financial knowledge to build wealth. You simply need consistent habits repeated month after month and year after year. Remember this simple principle: your financial future is not determined by one big decision. It is shaped by thousands of small decisions made consistently over time. If you found this video valuable, share it with someone who wants to improve their financial future and start applying just one good financial habit today. Your future self will thank you. Thank you.